Hey everyone, I'm Ilya, and welcome to my channel. Today we're going to talk about something that's been on many people's minds. Can an average American really build wealth in the stock market? I've been investing for years now, learning from both successes and mistakes, and I want to share what I've discovered along the way. Have you ever noticed how they try to sell you the dream of investing? Everywhere on social media, you see these influencers. They're always in some luxury villa, working on a MacBook by the infinity pool. There's always some crazy stock chart on their screen showing insane gains. Their pitch is always the same: become a millionaire by following their foolproof system. Just buy their course and their AI trading bot will do all the work. They show these incredible testimonials. Someone made $1 million in crypto. Another person turned $1,000 into $100,000 in a week. Hey, if you're tired of all these get-rich-quick schemes and want to learn how real wealth is built in the stock market, hit that subscribe button and turn on notifications. Let's dive into how it actually works. Now you've got all these investing apps making it feel like a game. Copy trading, social investing, AI advisors, they make it seem so easy. Just follow what successful traders do, right? Subscribe to their Discord or Patreon, get their hot picks, and watch your money grow while you scroll through TikTok. Sounds perfect, doesn't it? But what's the reality here? Will you get rich, or will you just end up funding these influencers' lifestyles? Let's break down how wealth is actually built in the stock market. No hype, just facts. Let's start with the basics. What exactly is a stock? It's a piece of ownership in a company. Think of a growing tech startup making $100 million a year. They want to expand, build new facilities, hire more developers, but they need money for growth. So they think, hey, let's sell part of our company to the public and use that money to expand. This is called an IPO, initial public offering. Let's say they want to sell 50% of the company, but keep control. Investment bankers come in and say, let's issue 10 million shares at $40 each. You'll keep 5 million shares, and we'll sell the other 5 million to the public. Then the marketing machine starts rolling. Investment banks and media start hyping it up. This company is the next Apple. They've got revolutionary AI technology. Their market could be worth billions. After all this hype, shares start trading on NASDAQ. What happens next is pure market psychology. One day, CNN reports that big tech is the future. Stocks go up. Next day, Fox Business warns about a tech bubble. Stocks crash. The company hasn't changed. They're still doing their work, developing products, serving customers, but their stock price swings wildly based on headlines and emotions. Let me give you a real example everyone knows: Tesla. In 2019, the stock was around $70. Some analysts were saying Tesla would go bankrupt. Just a year later, during the pandemic, the stock hit $900. Did Tesla's business really change that much in 1 year? No, but market sentiment did. Here's another story we all remember. During the crypto boom, people were taking out home equity loans to buy Bitcoin at $60,000. They were absolutely convinced it would hit $100,000. Many of these folks ended up selling at $20,000, losing their savings and going into debt. Or think about the 2008 housing crash. People were buying multiple houses with no money down, convinced real estate only goes up. We all know how that ended. Point is, when you try to get rich quick, you usually end up getting poor quick. Let's look at some hard data from brokers. Among retail day traders, 90% lose money in their first year. Of those who continue, only about 5% make consistent profits. And we're talking about people who study charts, use technical analysis, and treat this as a full-time job. Now, look at Warren Buffett. He didn't get rich through day trading or timing the market. He bought great businesses and held them for decades. His favorite holding period? Forever. That's how. Buffett's approach isn't just for billionaires. In fact, the most successful retirement funds follow similar principles. Think about successful pension funds and 401ks. They don't try to time the market or chase hot stocks. They invest consistently, month after month, year after year. It's not exciting, but it works. Let's do some math. If you invest $486 monthly in a basic S&P 500 index fund, and the market returns its historical average of about 10% per year, you'll have over $1 million in 30 years. Not from gambling on options or crypto, just steady, boring investing. Look at companies like Johnson & Johnson, Procter & Gamble, Coca-Cola. They've been paying and increasing dividends for over 50 years. Not very exciting companies, right? But if you'd invested $8,650 in them 30 years ago and reinvested dividends, you'd have several $100,000 today. We're all wired to think we're smarter than average. When GameStop was going crazy, Everyone thought they'd be the one to time it perfectly. Buy at $20, sell at $400. But for every person who made millions, thousands lost their savings. That's because we're naturally drawn to get-rich-quick stories, while slowly getting rich sounds boring. Remember the crypto craze? People were taking out loans to buy Bitcoin because they were afraid of missing out. What if it goes to 1 million? They weren't investing. They were gambling based on FOMO, fear of missing out. Now many are still down 70% from what they paid. Think about driving from New York to LA. You've got two options. You could try those back roads and shortcuts through unknown territory. That's like day trading. Sure, if you get lucky, you might shave off a few hours. But one wrong turn, one broken bridge, and you're stuck in the middle of nowhere. Or you could take the interstate. It's like long-term investing. Yeah, it's not exciting. You'll be doing 65 MEP, following the signs, making regular stops for gas. But here's the thing. Thousands make it to LA this way every single day. It's tested, it's proven, and most importantly, it works. Sure, you'll hear stories about someone who took some crazy shortcut and made it in record time, but you never hear about the hundreds who got lost, broke down, or just gave up and turned around. Same with investing. The boring route isn't just safer, it's actually faster in the long run. So what's the practical path? First, max out your 401k. If your employer offers matching, that's free money. Second, open a Roth IRA and invest regularly. Third, if you have extra money, consider low-cost index funds in a regular brokerage account. It's not sexy, but it works. Never put all your eggs in one basket, no matter how sure you are. I've seen people put their life savings into a sure thing, like Netflix at its peak or Meta before it crashed. Diversification isn't just a buzzword, it's your safety net. Time in the market beats timing the market. Look at any 20-year period in stock market history. Despite wars, recessions, pandemics, the market has always gone up over long periods. Your best edge isn't being smarter than everyone else, it's being more patient. Building wealth isn't about getting rich quick. It's about not getting poor slowly. You don't need to be a genius. You don't need to start with a lot of money. You just need discipline, patience, and time. The earlier you start, the easier it gets. That's it for today's video. If you found this helpful, don't forget to subscribe and hit the bell icon to get notified about new videos about investing. Check out my video about compound interest right here. See you in the next one.